Welcome to this explainer. You know, if you track global macroeconomics, or honestly, even if you just glance at financial headlines every now and then, you've definitely seen the wild rumors about the US dollar. Today, we're tackling the internet's absolute favorite financial myth, the petrodollar. We're cutting straight through the noise, ignoring the sensationalism, and looking strictly at the actual data and the historical records to see how this massive system really works. Let's get right into it.
So, did the petrodollar just die? If you were anywhere online around June 2024, you saw the massive panic. The story spreading like wildfire was that a 50-year petrodollar agreement between the United States and Saudi Arabia had officially expired. Boom. People were claiming it was the absolute end of American financial supremacy, the dollar was collapsing, and a totally new global order was born overnight. It was a perfectly packaged story of geopolitical drama. There was just one massive problem with the whole thing.
It was entirely fake news. Literally, a formal, expiring 50-year petrodollar treaty never existed in the first place. There was no ticking clock, no hidden expiration date, and absolutely no binding international law that forced oil to be priced in dollars. The entire panic was built on a complete misunderstanding of history.
Section 1. The viral petrodollar myth, cutting through the clickbait.
Okay, so if that June 2024 expiration date was a total myth, what actually went down 50 years ago? Well, the Atlantic Council really hit the nail on the head here. They stated flatly, there is no official agreement between the United States and Saudi Arabia to sell oil in US dollars. Instead of some rigid legal document, what actually happened back in 1974 was an informal arrangement. It was a mutual, incredibly pragmatic understanding built on shared strategic interests, which we're going to break down right now.
Section 2. Birth of the system. How we got here.
You see, this informal system didn't just pop out of thin air. It was forged in the fire of a profound global crisis. Let's trace the timeline. Back in 1944, the Bretton Woods system pegged the US dollar directly to gold. But fast forward to 1971, and President Nixon shocks the world by ending that convertibility, turning the dollar into a pure fiat currency. Suddenly, the dollar desperately needs a new anchor. Then, 1973 hits. The Yom Kippur War triggers a huge oil embargo. Prices literally quadruple, and there's a historic transfer of wealth to the Gulf states. Facing crazy inflation and a vulnerable currency, U.S. Secretaries Henry Kissinger and William Simon meet with Saudi King Faisal in '74. The brilliant solution they landed on? Anchor that floating fiat dollar to the one commodity the world simply cannot function without: oil.
Section 3. How petrodollar recycling works. The brilliant informal loop.
To really grasp how the petrodollar works, you have to look past the price tag. It's really about what happens to the money afterward. Think of it like a giant financial recycling loop. Step 1, global oil trade is priced exclusively in dollars, which creates a constant mass of demand for the currency worldwide. Step 2, oil exporting nations rake in those dollar revenues and hold them as foreign exchange reserves. But step 3 is the real kicker. They don't just sit on all that cash. They reinvest it directly back into safe, liquid U.S. Treasury securities. In plain English, oil money directly funds U.S. government deficits.
And this perfectly illustrates what economists call exorbitant privilege. Because the entire world needs dollars to buy their energy, and oil producers recycle those same dollars into US debt, America gets a massive economic subsidy. Research shows this structural demand actually suppresses US borrowing costs by an estimated 75 to 100 basis points. To put that into perspective, it essentially allows the US to consume way more than it produces, running persistent deficits, all while other nations foot the financing bill. Pretty wild, right?
But remember, this definitely wasn't charity. It was a deeply pragmatic bargain built on mutual dependencies. The US gets its deficits financed and gains incredible geopolitical leverage. In exchange, Saudi Arabia gets currency stability by pegging to the dollar, and most importantly, they get top-tier US military security. That security pact is so foundational that it was explicitly reaffirmed very recently in the November 2025 Strategic Defense Agreement under the Trump administration, securing new arms sales and defense cooperation. The ties run deep.
Section 4. The real geopolitical threats. Multipolarity and alternative systems.
Okay, so having established how robust the system actually is, we do need to look at the real complex threats it faces today. Because the turning point wasn't some fake contract expiring, it was the weaponization of the dollar itself. After the 2022 freezing of Russian dollar assets, countries paying close attention, especially those within the BRICS bloc, realized that relying entirely on dollar assets carried a massive geopolitical risk. This understandably pushed nations like China and Russia to hit the gas on building non-dollar settlement infrastructures, exploring alternatives like China's SIPs or the M-Bridge cross-border system.
But before we jump to conclusions, let's compare the reigning champion to the most discussed alternative, the hypothetical petro-yuan. The contrast is basically night and day. The dollar boasts deep global liquidity, universally trusted benchmarks like WTI and Brent, and it runs on the massive SWIFT network. The yuan, on the other hand, faces huge restrictions on convertibility, operates on a mostly regional scale, and is heavily constrained by strict capital controls. Actually replacing the incumbent is a whole lot harder than just criticizing it.
Section 5. Erosion, not a collapse. Let's look at the hard data. It's time to put the geopolitical drama aside and ground this in cold, hard numbers. Are we witnessing a collapse or just a slow erosion? Let's look at the IMF's latest Q2 2025 data on global foreign exchange reserves. Has the dollar declined? Yes, it's down from its peak of 72% back in 2001. But the data doesn't lie. At 56.32% today, the dollar still overwhelmingly dominates. The euro is sitting around 21%, and the Chinese renminbi is barely a blip at 2.12%. What we are seeing is very gradual diversification, absolutely not a catastrophic collapse.
And when we step away from central bank reserves and look at everyday market transactions, the dominance is even more extreme. The dollar is used in 88% of all global foreign exchange transactions. It accounts for 54% of global export invoicing and nearly half of all SWIFT payment messages. So while governments might be quietly hedging their bets, private markets and global businesses still overwhelmingly prefer the unmatched liquidity and the network effects of the US dollar.
Which brings us to a specific data point that definitively crushes the narrative that Saudi Arabia is aggressively dumping American debt. $149.5 billion. That is the exact value of Saudi Arabia's US Treasury holdings as of December 2025.
Let's dig into that number just a little further because it's fascinating. During the exact same time that viral expiration rumor was flying around, Saudi Arabia didn't dump their US debt. Their treasury holdings actually increased by $12 billion over the course of 2025. Actually, scratch that. November 2025 alone saw the largest single monthly increase in Saudi holdings of US treasuries on record. They aren't running for the exits, they are heavily invested in this system's stability.
Section 6. Future of the dollar. Where do we go from here?
So, if the primary partners are still buying into the system, what structural shifts will actually dictate the dollar's future over the coming decades? Well, that recycling loop we talked about earlier, it's evolving. The petrodollars aren't disappearing, but they are being managed very differently. Instead of just passively buying up US treasuries, Gulf states are utilizing massive sovereign wealth funds to buy global assets. The Saudi PIF, for example, just hit a staggering $913 billion in assets under management in 2024. They're actively transforming their domestic economy and making diversified global investments, which is fundamentally shifting how petrodollars flow through the global system.
But you know, the ultimate challenge to the petrodollar isn't a new currency, it's the demand for oil itself. Look at these conflicting projections. The International Energy Agency expects global oil demand to plateau by 2030, largely due to electric vehicles wiping out over 5 million barrels of daily demand. Now, naturally, OPEC disputes this and projects continued growth. But regardless of who has the exact timeline right, the reality is undeniable. The real long-term structural threat to the petrodollar is simply a world that eventually needs less oil to function.
Which leaves us with this final, vital question to consider. Will the slow, grinding reality of the energy transition eventually accomplish what geopolitics and rival nations haven't been able to do? As focused learners, it is so crucial to look beyond the viral clickbait and track the real, structural data. The petrodollar isn't going to vanish overnight on a technicality, but as global energy demands shift over the next few decades, the bedrock of international finance will inevitably have to shift with it. What do you think that new foundation will look like? Thanks for joining me for this explainer, and I'll see you.